Welcome to High Percentage Trading. This is Rob Reinhold again. Let's just jump right into it here. High percentage trading. What exactly does that mean? This is one of my favorite quotes. Now, I love Warren Buffett. Now, look, Warren Buffett's not a trader, he's an investor. But there are people out there in the world that every time they open their mouth, they say something, it's quotable because it's amazing. And Warren Buffett is one of those people. Everything he says is awesome. It's either really funny, it's really insightful. So I love this one. He says, look, the stock market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch. And I love that quote because that is so true, is that we don't have to click buttons. At Maverick, we always say, look, cash is a position. If you say, hey, I don't feel like there's the right opportunity for me, that's a trading decision. And some of those are the best trading decisions you can make. So in the market here, the market I've always said is a big wild animal. You cannot control what it's going to do. You cannot even predict what it's going to do. No, look, you can try to predict, but we have no idea what's going to happen. One of my biggest pet peeves is when I have a trader and I'm talking to them, hey, you're in this position, I don't like this position. They say, look, Rob, I know the stock's going to go up. And I always fire back with, look, you don't know bleep. Now I'm going to bleep myself here, but when I talk to them on an individual basis, I say, look, you don't know bleep. When you say that you know something, you have locked your behavior in to not being able to get out of that opinion. It's a really, really bad thing. So I always correct our traders. Whenever they tell me they know, I say, you don't know bleep. Now look, you can say, the statistics say it's highly likely to do this, or odds are it's going to do this. I'm totally okay with those verbiages. But to say you know something is like the worst thing you can say as a trader. As a trader, we have to take a look at everything as a game of percentages. And the only way to succeed in this business long term is to have an edge. Now, an edge, what is an edge? It is something that makes your decisions better than randomness. It's also called alpha, meaning that if you just bought the S&P 500, you just bought the spiders, you would get the same return as the S&P 500 every year. If you are making investment decisions and it is not producing better results than the S&P, you shouldn't be making decisions. You should literally just buy the S&P and go away and have a good life. So we need to have an edge. We need to have something we do that creates better than average results. And this is where we have intentional actions. We need to have a set of rules that we follow over and over and over again to produce this edge, because I've seen a lot of people that didn't know what they were doing, and they went out into the market and made a lot of money in the short term. But because they didn't have an edge, they always lost it. They always lost it. So look, you can go out and make money without an edge. That's fine. And I've seen it done a bunch of times. But in the end, no one has long-term success because the market is random. And if you don't have an edge, you will not win. It's like going to the casino. I've seen people go to the casinos and win money. But if you sit on a blackjack table, and even if you play perfect basic strategy, if you were to sit on that blackjack table every day of your life and play, you are a guaranteed loser because the odds are against you. You do not have an edge. That's why anyone who is a professional gambler, they go and play poker, where you're playing against other people. That's where you can actually go get an edge. So we are in the process of, again, helping our traders get to the point where they have that edge, where they've developed a repeatable strategy that can be produced and replicated over time. So the biggest thing about finding your edge, be very deliberate. This is really, really a big thing, not just in trading, in life. I was about to get all philosophical. No, I guess I am now. I've always told my kids, I've got two kids, they're 21 and 18, and I've always told them, whatever you do, be deliberate. If you decide, I'm going to do this, do it. Like be very deliberate in what you're going to do. Because if you're not, how do you know if you're even getting to where you want to be? So everything you do in trading, be deliberate. You need to have a set of defined rules. And again, we're going to do it all based on chart patterns. We're not going to have Ouija boards. We're not going to be flipping coins. It's all going to be based on time-tested technical analysis. Detailed entry points. When exactly are you going to get in? When exactly are you going to get out? These are very, very important things, and this is what you're going to be developing over this Market Master series, is those points. Let's go into my 10 trades analogy. Now, I love giving this 10 trade analogy story because this breaks down trading into a very, very simple, understandable concept. And it's funny because I've had people that have been trading for a decade, and when I go through this story, they say, Rob, no one has ever broken it down like that, and I wish I had seen this on day one. So here's the 10 trade analogy. You're going to make the next 10 trades. So let's just imagine the next 10 trades you're going to make. Now, in those trades, you're going to do your research. You're going to look at charts. You're going to do this. You're going to do your thing. And the only trades that you're actually going to end up clicking the button on are the ones you think are fantastic. Now, these are the ones that click all the boxes. Everything's right on them. It's the right time. It's the right stock. It's the right sector. It's the right everything. It's the right chart pattern. It is, everything about this is great because you won't make the trades that you don't think are very good. So by default, the only trades you're going to make are the ones that you are convinced that you're right on. And it's funny because my first 2 or 3 years of trading, if you were to ask me, Rob, do you think you can make money on every single trade? I'd say, of course not. Who is dumb enough to think that? That is so dumb. Of course you can't make money on every trade. Okay, what about the trade you're in right now? Oh yeah, this one's a guarantee. I got this one for sure. Does anyone see how ridiculous that is? Of course we can't make money on all of them, but this one for sure. This one's a guarantee. That was me the first couple of years. We have to understand that no matter how great a trade looks, it could be the worst trade you've ever made. And the only trades you're going to take are the ones you think are going to be really good. Now again, that mindset locks you into a path of decision making that could be very dangerous, because if you are so convinced that this is a good trade that you're willing to put some risk on it, it's going to be really hard to admit if you're wrong. So the way you have to look at it is you're going to make 10 trades. And some of those trades just aren't going to work out. They're just not going to work out. You did all your research and they just don't do anything. They didn't go up to where you wanted. They didn't go down all that much. They just didn't do much. And then you're going to have your winning trades. These are the trades that did what you want. Hey, I think this stock's going to go from 50 up to my target of 54, and it does it. And you're like, yes, that is fantastic. And then you're going to have some losing trades. These trades just don't work. A stock you bought at 50 that went to 54, it didn't. It went down to 48, 47. It just didn't work out. It just didn't happen. Then you're going to have a couple great trades. Now, great trades are the ones that far exceed your target. The stock you thought was going to go from 50 to 54 went to 67. You're going to get some of those. And then you're also going to get the really bad ones. It's going to be broken down and basically into the bell curve. And that's why I put the bell curve up here, is that your results are going to look like this bell curve. And I always tell people, the key to trading is to cut off this part. Cut that off. If you can cut that off and keep these, that's the game. That's the game you're trying to play here. So let's just do a simulation here. So let's say that you went out, you made 10 trades. 2 of the trades were mediocre. Okay. 3 of the trades were winning trades. 4 of the trades were losing trades. And 1 of your trades was a great trade. Okay. So let's say that this was your allocation. And let's just say that, let's just put some real simple numbers on here. Let's say your average winner was $1, your average loser was $1, and that great trade was an average of $3. So if we do the math here, your average win was $1.50. The average loss was $1. Now this trader was 50-50. So they had 4 winners, 4 losers. We're just called 2 break even. So this trader was at 50-50. They won half of their trades. But because of their profit factor, they had an overall positive result after 10 trades. All right, let's take another scenario. All right, so let's take this one where this trader has 4 losing trades, 4 winning trades. As you can see here, this trader breaks even. This trader breaks even. They sold winning stocks too early, but they didn't take any losses. They didn't take any big serious losses. So again, these were the numbers that they came down to. You can see that by removing that great trade, does everyone see that? The only thing that was different is I moved the great trade down to the winning trade. One of the biggest problems people have is they cut their winners. Cutting their winners, as you can see here, that changes the entire math. Without that big winner, the math changes. And after commissions, this trader is actually at a loss. One trade out of 10 that they mismanaged has changed it from positive results to neutral results, to break even. All right, well, let's take one more scenario. Let's take this scenario, and then let's talk about letting one of them get away from you. So this trader, they just let one of them get away from them. That's it, just one. Just one, that's all they got away from them. Instead of taking that $1 loss, they let it go too far, and it ended up being a $3 loss. As you can see here, all of a sudden the numbers change. They change. You're going to make 10 trades. The next 10 trades you make, you're only going to make them because you think they're great. In those 10 trades, you have some winners. And you probably have one amazing winner. And in those group of 10, you have some losers. And you probably have one really terrible one. One that's going to do way worse than you ever thought. Here's the problem. We have no idea which one is which, do we? Now look, we think they're all good. We think they're all going to be good. We have no idea which one is the great one and which one is the one that's going to break you. This is why position management. Position management is the key to everything. Now, a lot of traders put a lot of focus, and rightfully so, on the entries. And they put all of their decision making on the entries. And if you pick up a regular random trading book on charting, you're going to see 98% of that book is on this. And you're going to have a small little bit on trade management. Here's the problem. That's the easy part. The trade management is the hard part. That's the hard part. Studies have shown, and again, a company called FXCM, they're the largest Forex broker in America. They took all of their trades from their retail accounts for an entire year. It was over 12 million trades. And they actually broke it down. And they broke it down and they showed that 59% of all the trades made that year by their retail traders were winning trades. Hey, look at that. That's pretty impressive. However, 6% of their accounts made money during that year. Only 6% of the traders made money during that year at FXCM. Why? Well, here's why. The average loss was 119 pips. Now, pips are just like dollars and cents in currency. The average gain was about 60. So here are the numbers. 59% of the time they made 60 pips. 41% of the time, they lost 120 pips. As you can see, the math doesn't work. People are very good at making this decision. People are very bad at making this decision. And this makes sense. I've done a lot of reading over the past 10 years. I no longer read trading books. I haven't read a trading book in probably a decade. I now read psychology and behavioral finance books. And it talks about why we do what we do as human beings. They did a study where they hooked people up to an MRI machine and they played a game of chance. Well, when there was no money on the line, the brain activity was in the prefrontal cortex. And this is where you have logic and reason. This is where these decisions are made. However, the second they put money on the line, the prefrontal cortex stopped firing as much, and other parts of the brain started to be engaged and activated and start to show brain activity. These were parts of the brain that dealt with fear and loss and were totally based on emotions. Here's the point, is as human beings, we are actually incapable of using the correct part of our brain when it comes to the exit. This is why you need to have very, very clear exit rules. And before I wrap this series up here, I need to tell you all one story. I started trading in 1997. I did fairly well in 97. I did very good in 98. In 99, I was doing very good. And in late 1999, I became convinced that the dot-com bubble was going to pop. Convinced. I mean, so convinced that I knew it. I knew it into my bones. I knew it. I knew it, and it was crazy. It was stupid. How could stocks that had never made any money go from $20 up to $400? I knew it was going to pop. I knew it. So I was waiting for my opportunity, and I came across this stock. This stock's name was Phone.com. Now, let me tell you about this stock. This stock had come public at about $20 a share. And over the first couple months, it had run from $20 up to $100 a share. Now, let me tell you about Phone.com's business. Phone.com had never, ever made a profit. Actually, Phone.com has also never, ever sold $1 in revenue. They had never even recorded $1 in revenue. And in fact, they didn't even have a product yet. They were in development of a product, but they didn't even have a product yet to sell. But the idea was it was going to be something with either a phone or a computer or maybe both. They weren't sure yet. That's why its name was Phone.com. The stock is quadrupled. And I remember looking at this thing saying, this is the biggest joke. And I remember looking at this, the stock was at 98.5. This is back when we trade fractions. And I'm like, this is a no-brainer. I'm going to short this thing at 98.5. I'll cover it at 80. This is going to be an easy 20 grand. So I did 1,000 shares. 1,000 shares short. And I put a stop in at 100. I said, look, if it breaks 100, I don't want to be in it. So I said, look, I'll control my risk. I won't let this one get away from me. I'll put a stop in. Well, the stock wouldn't go down and it went up. And when it got up close to 100, I looked at it and said, I am not losing $1,500 on Phone.com. I know it's going down. I know it. So I canceled my stop. Somewhere around $128, it started to get painful, and I was like, "Oh, this is not good." But I'm not going to get out of it here. I'm not going to get out of it here. But I trimmed some down. I was, look, I'll trim some here, and then I'll put it back on later. But I'm not taking this loss on Phone.com. I know it's going down. Somewhere around 156, I said, "Oh, this is getting really bad. I better trim some more." But I'm not getting out. Well, it's $216.05. I still remember that point. I was pushed out by margin. And it got to the point where I had basically completely killed my account. I blew it up by 85, 90%. And there was very little left. And I remember at that time, I was a young father. I had a little 8-month-old. Yeah, 8-month-old. And I remember coming home from the Maverick office, driving home, and with tears in my eyes, tears. And I thought, what am I going to do? How'd this happen? I let one trade erase 2.5 years of hard work. And now I had to look forward and say, what am I going to do now? I did some soul searching, and that was one of the times I really contemplated, is this for me? Is this going to make it? But you know what? I decided, I know I can do this. I just have to not ever do that again. So I went and got a little temp job, and I studied and practiced. I borrowed some money from my dad, which was a blow to my pride, but I paid him back in 3 months, and I proceeded to then have a great trading year in 2000. And you know what? I was right about phone.com. I was right. However, the stock went up to $320 first. And in 2002, I actually read their bankruptcy filing. They never made a product. They never made a product. Can you believe that? So I was right, but I was wrong. I tell that story to our traders. I think it's a very valuable story because that was a very low point in my life. And I still remember those feelings. And I know that we've had traders that have come through our doors that have also been at that point. I hated that point. And I know you probably hated that point. But looking back on it, I had to experience that. Because from that point on, I said to myself, I will never, ever even put myself in the situation where I could lose everything again. And I needed to learn that lesson. I wish I didn't. I wish I could have been the person that hears don't ever pull a stop and just goes with it. I sadly am not that person. I've got to test things out for myself. But the trade management is so serious. So looking back on it, it was the best thing that could happen to me. It was horrible and terrible, and it was awful. But it taught me, hey, the 10 trade analogy. This is it. This is it right here. Everything I talked about. You need to cut this part off. This is the game of trading. You have to cut off these terrible trades. You cannot let them happen. And here's the thing. The market is very volatile. And I put this chart up because this was right at the start of the coronavirus. We went down 35%. Anyone in a leveraged 3-time ETF, they took 100% loss on that ETF. This was, and no one could see it. This came out of nowhere. No one could see it. Things will happen. If you aren't paranoid, if you aren't looking at this saying, hey, look, every trade I make could be the worst trade I've ever made. And every trade I make could be the greatest trade I've ever made. And you treat them all the same, where if they don't work, you minimize your risk. And if they do work, you maximize your gain. That is the key to trading. This is all on 50-50. This is flipping a coin. This is a 50-50 win-loss. But if you control your winners and make more on your winners, control your losers, make more on your winners, that's the key to trading. Always remember that 10 trade analogy. You're going to make 10 trades. You think they're all great. Some are going to be terrible. One's going to break you. And one's going to make you a ton of money. Which ones are they? You don't know until you make them. And that's where the trade management comes in. All right, so to wrap this up, it's all about finding your edge. Build a repeatable system. Everything gets back tested. People ask me all the time, Rob, which one's best? I said, go back test it. Go back test it. There's tools out there. We'll show you how to back test it. Go back test it. If you don't like your results, go do some testing. And then, of course, understand that position management is the key to profitability. It is the absolute key. All right. Thanks for joining me, everyone.